In this video, we're going to look at some statistics for the stock market, mainly the S&P 500, during mid-February to mid-March. It's a historically bad period for stocks. But the real question is, I'm just a market nerd, so I love having all these statistics. I like to know the information, and then I can decide if I want to incorporate it into my own personal trading plan. So the real question is, when you hear statistics like this, should you care? As new traders, often, they're just trying to pull too much information. What's relevant, what's not. So let's discuss that. First, let's discuss the tendency. So the S&P 500, exemplified by the Spider S&P 500 Trust, or SPY, has fallen between February 15th and the end of February in 16 of the last 31 years, and the average loss is about 1%. So, that might not seem like a lot. But when you average it out, you have all the up years, all the down years, and so on average, it's a losing period. And so it's only gone up 48% of the time. Only, 16 out of the last 31 years. That's actually flipped upside down. Oh yeah, it's fallen in 16 out of the 31 years. So less than half of the time it's gone up. This tendency continues into March. So from February 20th, which is, I'm recording this on February 19th, our first trading day of the week due to a holiday is going to fall on February 20th. So between February 20th and March 13th, the average return is minus 0.4%, so still negative. But we've moved up slightly. We've moved up 16 out of 31 years. So just a slight upward bias in terms of how many of those periods we've tended to move up, but the average return is still negative. So it's not until March where the market tends to historically act better during that period. So from March 14th to April 30th, big difference. Average of almost 3% increase, and it's moved higher 23 out of 31 years, or 74% of the time. So we can see there are periods that, at least historically, have had more luck, we could call it, in terms of going up, and periods that seem to have poor luck in terms of going up, for whatever reasons those happen to be. So the real question is, should you care about this when you see that the market tends to drop an average of 1% during these periods? And remember, there's going to be big fluctuations. This is just an average. Some years we've been up 10% during this period. Other years we've been down 12%, 15%. So it's an average. And so on average, is it worth stepping aside during this period if you're an investor or a trader? What should you do? So I always recommend, if you're trading or investing money, you should have a system that you are following. If you're a new trader, you're basically developing that system, but you should have rules for when you buy and when you sell. If you don't, then you shouldn't be really trading or investing until you have those rules in place. Otherwise, you're going to be trading on usually extreme emotion when you see the market rise or fall, and that's not generally good. You also want to note your preferences and your time frame. So let's go through a couple examples. If you're an investor, then maybe your main data point is that over the last 100 years, the average annualized return of the S&P is 10.5%. If that's your goal to achieve that, then you just hold until basically you have to sell in retirement or whenever you've set your rules to sell. But you don't sweat the minor fluctuations. Another investor may want to get in and out of the market. And in that case, they may want to use some seasonal tendencies. They may look at these tendencies and say, you know what, I'm going to wait till the price drops a little bit, then I'm going to use those as my entry opportunities. And they may use seasonal patterns very extensively, kind of getting in at certain times of the year, getting out for other times of the year. Swing traders, my main objective as a swing trader is always just to ride the momentum. I don't use moving averages a whole lot, but we could use them just as an example. So we trade long when the indices or the high momentum stocks you're trading are above their short-term moving averages, such as their 10, 20-day moving averages. And then I'd be wanting to get out when the prices drop and stay below those 10, 20-day moving averages. Now that's a kind of shorter term swing trader, right? We're looking at short-term moving averages. If you want trades that last months, you don't want to be getting out in and out of the market too often. Maybe you'd be looking more at 20, 30-day moving averages or 50-day moving averages. So there's always, every trader is going to trade a little bit differently, and that's why it's important to note your own preferences, your time frames, what kind of trader you want to be, because this information may be important to you, or it may be not important to you at all. And ultimately, it's up to you to decide whether you want to include this type of data in your trading plan or not. Just some information on the overall market conditions. One thing about seasonality is that it doesn't look at what was going on at the time. Maybe these prior Februaries, we would have had lots of markets in uptrends, lots of markets in downtrends. We would have had periods where the market was very overvalued, periods where the market was very undervalued. But when we just look back, all we see is the summary data. We don't see what was going on in those periods. So it's important to look at what's going on right now. The S&P is currently in an uptrend. Pullbacks have been very minimal, and if we look at historical uptrending periods, up to 6% pullbacks are just very routine and common. So they can occur anytime, and that's just part of trading. And we can also look at price to earnings ratios of the S&P 500, and right now we're at about 22. We're not extremely overvalued or undervalued. That's a very common value since 1990. Prior to that, we tended to have a little bit lower P's, but over the last 30 plus years, it's been, or 30 years and a bit, it's a very common level. So we can look at the S&P. We can look at the S&P 500, and basically since this bottom here in October, we've been in a very strong uptrend. This little line is just showing any move that's bigger than 2%. So you can see we have even these pullbacks, like these didn't even get to 2%. This one was 2.3% off the high. This one was 2.5% off the high. So these are very common type pullbacks in a bull market. And, even if one of these was 5% or 6%, that'd still be a very common number. So it's important to just, I like to have all this data just so, I can decide which I want to include in my actual trades, what is actually going to cause me to enter or exit trades. And it also gives me a good kind of just overview of how the market moves, so that I can develop strategies around that if I want to use that information. So overall, market's still in an uptrend, but historically, we're heading into a weaker period of the year.